Welcome to Griffonomics.
Glad to be here.
So, if you picture a barren, dusty stretch of West Texas desert, you know, you probably aren't picturing a massive tech hub.
Right. No, definitely not.
It's mostly just scrubland, dirt roads, pump jacks, basically as far as you can see.
Exactly. It's oil country.
But right now, some of the absolute biggest tech companies on Earth are looking at this exact patch of dirt.
Yeah.
And they're trying to turn it into, like, the equivalent of a nuclear-powered Silicon Valley.
Which is wild to think about.
It really is. So today, we are doing a deep dive into the company that actually owns the dirt underneath all of this.
Yeah, and it's truly one of the most fascinating corporate evolutions I think we're seeing right now. Because on paper, I mean, if you just glance at their historical filings, you just see a standard Texas oil and gas land management company.
Right. But our mission for this deep dive is to execute a really granular strategic analysis of this company. They're called LandBridge, or LB.
LB, right.
And we are looking at a massive stack of sources for you today. We've got their incredibly detailed financial documents, the Q1 2026 earnings transcripts, and some internal Griffonomics analyst reports.
All of which are pointing to a massive shift.
Exactly. The core question we are trying to answer for you is LandBridge just this legacy land management company, or are they actually pulling off a massive pivot? Like, are they becoming a highly profitable digital infrastructure utility?
Right. Are they the hidden key to the AI and data center boom?
Which is a multi-billion-dollar question.
Absolutely. Because if the broader market starts recognizing them as a digital utility, I mean, their valuation paradigm just completely changes.
It flips.
Totally flips. They stop getting valued like this cyclical commodities business, right? And they start getting valued like a long-duration tech infrastructure play.
Which brings us to the numbers. Because if you are looking at your portfolio right now and you see these figures, your brain is immediately going to tell you that something is either a miracle or it's completely mispriced.
The margins are crazy.
They are staggering. Right out of the gate, the Q1 2026 numbers show LandBridge operating with an 88% adjusted EBITDA margin.
Yep.
And an 80% free cash flow margin.
Okay, let's actually ground those finance terms for a second because they are the whole foundation of why this company is just so interesting.
Let's do it.
So an 80% free cash flow margin, that basically means that for every actual dollar of revenue that comes in the door, they keep 80 cents of it free and clear.
80 cents on the dollar.
Right. That's cash they can just use to pay down debt or issue dividends or just hold on the balance sheet. They aren't spending it on maintenance. They aren't buying heavy equipment.
And that's the part that is so hard to wrap your head around.
Yeah.
Because you almost never see margins like that outside of, like, pure software company.
Exactly, like a sauce business.
Right. Seeing it in physical infrastructure, in land management, out in the harsh Permian Basin environment, it means we really have to unpack how they are actually achieving this.
It's a very complex web.
It is. It's this web of West Texas land rights and massive water cooling networks and private natural gas grids.
Yeah, and to really understand how they are positioning themselves for this whole data center pivot, we actually have to take a step back. We need to dissect how they fundamentally make money today, like right now.
Yeah, we have to establish the baseline before the pivot.
Exactly.
Okay, well, let's unpack this baseline.
Yeah.
Because the sheer scale of what they do currently is just hard to comprehend. LandBridge owns over 320,000 surface acres in the Delaware Basin.
Which is essentially the most active western half of the Permian Basin.
Right. And that footprint, just to visualize it, that's roughly the size of a small state. But here is the really critical distinction for you to understand.
Yeah.
They don't actually drill for oil themselves.
No, not all.
They are an exploration and production company. They are essentially a toll booth.
Yes, that's the perfect word, a toll booth. They operate what the energy industry calls a capital light model.
Capital light.
Right. And to really grasp why this is so lucrative for them, you have to compare it to the traditional energy infrastructure business, which is just brutally capital intensive.
Right, like laying pipe.
Exactly. Think about a standard midstream pipeline company. If they want to move oil or water, they have to spend hundreds of millions, sometimes literally billions of dollars buying steel pipe, securing the right-of-ways, hiring these massive labor crews, pouring concrete.
Taking on all the debt to finance that construction.
Exactly. They take on massive debt. LandBridge flips that entire script because they hold the surface rights.
The dirt.
The dirt. So the tenants, the massive oil and gas operators, the pipeline companies, they're the ones who actually bear all those multi-billion-dollar capital expenditures.
Oh, wow.
Yeah, the tenants buy the steel, the tenants build the infrastructure right on top of LandBridge's surface, and LandBridge just sits back and collects royalties for the right to use their dirt.
So wait, if I'm understanding this correctly, it's like, let's say you own the only piece of land right next to a massive gold rush.
Right.
You aren't taking the risk of buying the pickaxes. You aren't digging the mines yourself.
No.
You are just setting up a toll booth, and you're charging a massive fee for people to park their wagons, cross your property, set up their tents.
That is precisely the dynamic. But what makes this particular gold rush so unique is what the reports refer to as the 5-point symbiosis.
Okay, yeah, let's dive into that.
Because LandBridge doesn't just randomly collect these tolls in a vacuum. They are backed by a private equity sponsor, a firm called 5-Point Energy.
Right.
And 5-Point Energy has engineered this highly integrated, closed-loop ecosystem.
Because 5-Point doesn't just own LandBridge, right?
Correct. 5-Point also runs a company called WaterBridge.
Which does water management.
Right. They are one of the largest water management companies in the oil field. And they also run a third company called PowerBridge, which is tasked with developing digital and power infrastructure.
So you have three totally distinct companies, LandBridge, WaterBridge, PowerBridge. But they're all operating under the exact same umbrella.
Well, it's more than just the same umbrella. They share a deeply intertwined management structure.
Like the executives are the same.
Literally the same. For instance, David Capobianco, he serves as the chairman for LandBridge and for WaterBridge and for PowerBridge.
Oh, wow. Okay, so map this out mechanically for us. How do these three entities actually interact out there on a single patch of dirt?
So it works like this highly engineered machine. LandBridge holds the core asset, right? The dirt itself. They have the permanent surface rights.
Right.
Then WaterBridge comes in to build these massive pipelines and disposal wells to move water across that dirt. And now PowerBridge is entering the picture to develop data centers and power plants on that exact same dirt.
So if a tenant, let's say a major oil operator or some tech company wants to do business out there, they aren't just negotiating with some passive mom-and-pop landlord.
Not at all.
They're entering this very sophisticated ecosystem. But, you're praising this capital-light model, and to me, it honestly sounds kind of fragile. Well, if LandBridge doesn't actually own the infrastructure, they have no control over it, right?
That's true.
So if an oil tenant goes bankrupt and abandons a multi-million-dollar pipeline, isn't LandBridge just left with a totally useless piece of rusting metal on their dirt?
So that is a very astute challenge, because in traditional commercial real estate, if a tenant goes bankrupt, you just have an empty building.
Exactly. You get no rent.
But out in the Permian Basin, the infrastructure itself, the pipeline network, the deep water disposal wells, it is structurally critical to the entire region's output.
Okay.
So if one operator goes bankrupt, the underlying oil and gas reserves are still sitting right there in the ground. Another operator just buys those assets out of bankruptcy, and they immediately need to use that exact same pipeline and that exact same dirt road.
Ah, I see.
So the toll booth just remains open, regardless of whose name is actually painted on the wagon.
The geography itself is the monopoly.
Precisely. And that monopoly power is how you get to the financial reality we touched on earlier. Let's actually look at the Q1 2026 metrics to see this in action.
Let's do it.
So they generated $51 million in revenue for the quarter.
Which is a 16% year-over-year increase, right?
Right. But again, the most vital metric is that they generated 80 cents of free cash flow for every single dollar of revenue.
Walk me through the actual income statement on that.
Yeah.
How does the cash cascade down without getting eaten up by expenses?
It's all about the absence of capital expenditures, like we said, capital light. In Q1 2026, LandBridge's growth capital expenditure was just $0.2 million.
Wait, $200,000?
$200,000.
For a company with an enterprise value hovering around, what, $5 billion?
Right. $200,000 is practically a rounding error.
That is wild.
And it's because WaterBridge and the third-party exploration companies are the ones actually buying the steel and paying the massive labor costs. So LandBridge's operating expenses are just incredibly low.
Okay, so the money comes in, and there is basically nothing pulling it back out. Where exactly is this revenue coming from right now?
Well, let's break down the current revenue mix, because it's important to see how insulated they really are. In Q1, 72% of their revenue, which is about $37 million, came from surface use royalties and revenues.
Which means what, practically?
That's charging for pipeline easements, road access, facility pads, basically rent for the dirt.
Got it.
Then another 22% came from resource sales.
Resource sales, like they are selling the actual oil and gas minerals underneath.
No, and this is where it gets really interesting. They are selling the surface resources. They literally sell the dirt.
Wait, what?
They sell the caliche dirt that operators use to build the heavy-duty roads. They sell the sand that gets used for fracking. They sell the brackish water.
So wait, they're literally selling the dirt to the people who are building roads on their dirt.
Exactly. It's brilliant in its simplicity.
That is crazy.
I mean, if an operator needs to build a road to access a drilling site, they need a tough, compacted surface, right? Caliche is perfect for that and sitting right there on the property. So LandBridge sells them the caliche, and then they turn around and charge them a toll to use the road they just built with it.
That is honestly wild.
And importantly, only 6% of their revenue came from traditional oil and gas mineral royalties.
Which is where you take a percentage of the actual oil produced.
Right.
And I see why that's so critical. Because if they rely heavily on oil royalties, their revenue would just spike and crash with the global price of crude. Like, if oil drops by $20 a barrel, a pure mineral royalty company takes a massive hit.
Exactly. But LandBridge doesn't. Even if the price of oil dips and drilling slows down a bit, the existing wells are still producing. The pipelines still have to move the oil and water.
The roads still get driven on.
Right. The toll booth just keeps collecting. They have deliberately insulated themselves from the severe volatility of commodity prices.
Okay, so that establishes an incredibly solid foundation. You have this highly lucrative capital-light toll booth model that basically just prints cash from surface rights and dirt sales.
Right.
But a solid toll booth business doesn't justify the massive valuation multiples we are starting to see discussed around this stock. It doesn't explain the digital pivot at all. So let's explore the massive catalyst that triggered LandBridge's recent guidance hike.
Yeah, this is where we move from their present reality to the strategic inflection point. We need to talk about the Alpha Digital campus.
Right, because this is where the story shifts from, smart Permian land company to Silicon Valley's landlord.
Exactly.
So in Q1 2026, they signed this agreement with PowerBridge for the Alpha Digital campus. And the filings describe it as an option to lease 3,400 contiguous acres in Reeves County, Texas.
Which is a massive plot of land.
Right. 3,400 acres is huge. But the target power capacity is what really caught my eye in these reports. They were targeting 2 gigawatts of co-located power.
Yeah, and to put 2 gigawatts or 2 GW in perspective, we really have to look at the scale of current data center infrastructure.
Okay, give me a comparison.
A typical large-scale enterprise data center, the kind that runs standard cloud applications for major corporations, that might draw maybe 50 to 100 megawatts of power.
Okay, so 2 gigawatts is 20 to 40 times larger than a standard massive data center.
Exactly. It is the power equivalent of what it takes to run a small city. Literally the output of a massive nuclear reactor.
Wow.
We are not talking about a few server racks here. We are talking about gigascale, hyperscale infrastructure that is specifically designed for training massive artificial intelligence models.
Because AI requires so much more juice.
Unbelievable amounts. These AI clusters require an unprecedented density of power.
And the timeline they are telegraphing to the market is just incredibly aggressive. I mean, the milestones laid out in the filings show they are aiming for first power in 2027.
Right. Next year.
And then large-scale generation coming online in 2028. And the market clearly reacted to this, right?
Right.
The board just raised the full year 2026 adjusted EBITDA guidance by $5 million across the board, moving the range up to $210 million to $230 million.
Which is a very confident, honestly, almost aggressive signal to send to the market, especially when you consider that if you look at the sequential quarter-over-quarter numbers from Q4 2025 to Q1 2026, their revenue was actually slightly down.
Right. And here's where it gets really interesting and where I frankly got a little bit skeptical reading the transcripts.
Let's hear it.
I looked at the actual financial details of this PowerBridge deal. LandBridge only received a $2.6 million non-refundable option fee for this deal in Q1. That's it.
Right.
Just a $2.6 million option fee to hold the land. So my question is, how does a relatively tiny option fee justify raising the entire corporate EBITDA guidance by $5 million? Are they just counting their chickens before they hatch to bump the stock?
That is a great question, and it was the primary focus of almost every analyst question on the earnings call. It looks like a mismatch on paper.
It really does.
But to understand why management is raising guidance, you have to understand how option fees actually function in massive commercial real estate development. And you have to look at how management views their overall pipeline.
Okay, walk me through their logic on this.
So management frames that $2.6 million not as just a one-off payment, but as a highly credible forward-looking indicator of repeatable revenue.
Meaning what?
Meaning when PowerBridge pays that non-refundable fee, they aren't just putting a reserved sign on the dirt and going away for a year. The filings indicate that PowerBridge immediately began advancing site development. They initiated geotechnical surveys.
Geotechnical surveys, meaning they're actually out there drilling into the dirt to test if it can physically support massive concrete data center foundations.
Exactly. They're spending real money. Furthermore, they filed a generation interconnection request.
Okay, what is that, practically speaking?
A generation interconnection request is a massive regulatory and engineering step. It's essentially formally petitioning the Texas grid operator to say, hey, we are building a massive power source right here, and we need to study exactly how it will physically connect to or interact with the existing grid infrastructure.
Which takes a lot of time and money.
It requires heavy, expensive engineering work to even file that document. And beyond that, the transcripts note that PowerBridge has actually started ordering long lead equipment.
Okay, so long lead equipment, that would be things like the actual massive gas turbines or specialized transformers that take, 3 years to build and get delivered?
Exactly. So from management's perspective, this isn't a speculative, maybe someday option. PowerBridge has immense skin in the game right now.
Got it.
And LandBridge management combines that signal with what they call increased commercial pipeline visibility for Q2 through Q4 of 2026.
Commercial pipeline visibility, that's corporate speak, meaning they see more deals currently being negotiated that will hit the books later this year.
Right. They have a highly supportive macroeconomic backdrop. They have elevated demand for their traditional resources like sand and water on the oil field side, and they just know the mechanics of their own business.
Right.
Because in land management, you often get this upfront lumpiness.
Lumpiness.
Yeah, like a massive one-time damage payment when a company brings in bulldozers to clear 3,400 acres. Management knows that this lumpy upfront cash inevitably turns into a recurring, multi-decade royalty stream once the infrastructure is actually built. So they are raising guidance because they see the foundational floor of their revenue rising underneath them.
Okay, I follow the logic on the guidance hike. The option fee is just the tip of the spear, but it begs a much larger foundational question for me.
Which is?
Why West Texas? I mean, if you were a tech giant, an Amazon, a Google, a Microsoft, and you were looking at a map of the United States to build a 2-gigawatt AI campus that is going to cost billions of dollars, why do you point your finger at Reeves County, Texas?
It's remote.
It's incredibly remote, it's scorching hot, and it's far away from the major fiber optic backbones on the coasts. Why LandBridge?
That is the crux of this entire digital energy convergence theme we are talking about. To understand why they are going out to the desert, you have to understand the absolute physical constraints of gigascale data centers today.
Okay.
They are facing 3 massive bottlenecks right now: power, water, and land zoning. And LandBridge offers a structural solution to all 3 simultaneously.
Let's take those one by one. Start with the power mode. We established they need 2 gigawatts. Why can't they just plug into the grid in Silicon Valley or in Virginia?
Because the traditional utility grids in places like Northern Virginia, which is historically the data center capital of the world, those grids are completely congested.
They just can't handle the load.
The public transmission lines physically cannot handle a new 2-gigawatt draw. If a hyperscaler goes to a traditional utility today and asks for 2 gigawatts, the utility will just tell them it'll take 5 to 10 years to permit and build the high voltage transmission lines necessary to deliver that power.
And the tech companies can't wait 10 years. The AI arms race is happening right now. They need it yesterday.
Exactly. So they have to find a place where power is natively abundant and where they can bypass the public grid entirely.
Okay.
Have you heard of the Waha Hub?
I have, yeah. It's a major natural gas pricing and trading point located in West Texas, right there in the Permian Basin.
Right. And LandBridge's southern acreage is located directly adjacent to the Waha Hub. This is so critical.
Because of the gas supply.
Because the Permian Basin produces an ocean of natural gas as a byproduct of oil drilling. In fact, Sometimes there is so much gas and so little pipeline capacity to take it away to the coast that the price of gas at the Waha hub literally goes negative.
Wait, negative, meaning the drillers have to pay people to take the gas away.
Literally pay them to take it away.
So if you put a data center there, you have access to some of the cheapest, most abundant energy molecules on the planet, literally right under your feet.
Which enables the solution to the grid congestion problem. It's a concept called behind the meter, or BTM generation.
I've seen that term a lot in these analyst reports. Behind the meter, mechanically, what does that actually look like on the ground?
So think of the Texas public power grid, ER codes, like a massive public highway system.
Okay.
Right now, that highway is congested. It takes years of environmental reviews and politics to build a new off-ramp, and during a severe winter storm, the whole system can just lock up.
We've seen that happen.
Right. Well, behind the meter means you don't use the public highway at all.
You just build your own road.
You build your own massive private power plant right next to the data center. The power generation source and the data center share the exact same piece of private land, and crucially, they share the exact same meter. The electricity never touches the public transmission lines.
Wow.
In this case, PowerBridge is proposing to build a massive natural gas power plant fueled by that incredibly cheap Waha gas, sending electrons directly into the AI servers next door.
So they're essentially seceding from the public grid. They are building a private energy island to guarantee they have power and to avoid waiting a decade for the public utility to catch up.
It guarantees them power certainty, extreme operational resilience, and speed to market. That solves the power bottleneck.
Okay, but power is only half the equation here. We need to talk about the water. Because this is where the five-point symbiosis really flexes its muscles, and it creates a moat that seems almost impossible to replicate anywhere else.
It really does.
Let's frame the water problem first for the listener. Why do these data centers need so much water?
It comes down to basic thermodynamics. When you have tens of thousands of highly advanced GPUs running complex AI training models simultaneously, they draw massive amounts of electricity.
Right.
And nearly all of that electricity is converted into heat. If you don't remove that heat instantly, the servers will literally melt themselves.
They have to cool them down. And I assume traditional air conditioning just isn't enough for these massive AI clusters.
Not even close. You need massive liquid cooling systems. This involves pumping millions of gallons of water through cooling towers or even piping it directly to the server racks. The water absorbs the heat, evaporates, or is cycled out, and fresh water is continuously cycled in.
And here is the political reality of that. In most parts of the country, whether we are talking about Arizona or Virginia or California, if a tech company shows up and says, "Hi, we'd like to use millions of gallons of your municipal drinking water every single day to cool our computers," there is going to be massive, immediate public backlash.
Oh, absolutely. You are suddenly competing with local farmers for agricultural water, and you are competing with residential neighborhoods for drinking water. It becomes a zoning nightmare and a huge PR disaster. Local city councils will simply block the permits.
Enter WaterBridge.
Precisely. This is why the LandBridge ecosystem is so brilliant. Remember, WaterBridge already operates 1.5 million barrels per day of water handling capacity right there on LandBridge's surface.
But that's oil field water, right? Not drinking water.
Exactly. It's what they call produced water, which is this highly briny, toxic water that naturally comes up out of the ground alongside the oil. And they also manage brackish underground water sources that are completely unfit for agriculture or human consumption.
Okay.
So WaterBridge already has the pipelines, the massive pumps, and the deep underground disposal wells fully permitted and operating.
So mechanically, how does this work for the data center?
WaterBridge provides a turnkey, completely private solution. They tap into those brackish water aquifers to supply the millions of gallons needed for the cooling towers. The water absorbs the heat from the servers. Then, instead of dumping that heated, chemically treated wastewater into a local river or lake, WaterBridge takes it back, pipes it away, and injects it thousands of feet underground into their permitted disposal wells.
So the hyperscaler never has to attend a local city council meeting to beg for a water permit.
Never.
They never compete with a local farmer. They just write a check to the five-point ecosystem, and the entire thermodynamic cycle is handled, completely isolated from public water supplies.
It completely de-risks the project from a regulatory and public relations standpoint. It's a massive advantage.
Okay, so we've established the structural genius of the geography. You have the cheap Waha gas for private power, and you have the water bridge network to handle the cooling.
Yeah.
All of this is happening on massive tracts of land where nobody's going to complain about zoning.
Right.
But what does this actually mean for LandBridge's bottom line? Like, how do they extract the maximum financial value from this specific setup?
This brings us to the absolute core of their financial strategy, and it's a concept they call monetization layering.
Monetization layering.
Yeah, it's all about exponentially increasing a metric they track very closely. Their surface use economic efficiency, or SUE.
SUI. Okay, I need to really understand this layering. Let's trace the financial sequence of a single plot of land. Let's just use the 3,400 acres for the Alpha Digital campus as our example.
Yeah.
Walk me through exactly how they ring the cash register at each step.
Okay, we can break it down into 4 distinct layers of monetization. Step 1 is pre-development. This is the phase we are in right now.
The option phase.
Right. LandBridge collects the upfront option fees, like that $2.6 million we talked about, but it also includes surface damage fees.
Damage fees.
Yeah. When PowerBridge or the hyperscaler brings in massive earth-moving equipment to clear the scrubland, level all 3,400 acres, and pour concrete, they have to pay LandBridge a one-time fee for altering the surface. That's your first layer of upfront cash.
Got it. Upfront cash, just for the right to start messing up the dirt and building. What's layer 2?
Layer 2 is the digital lease. Once the physical data center is actually built and operational, LandBridge starts collecting a base rent for the land underneath it.
Okay, that makes sense.
This is structured as a long-term, multi-decade lease. It's a very standard commercial real estate transaction. The landlord gets the rent check every month.
Simple enough. But rent alone doesn't get you 80% free cash flow margins.
Exactly. This is where the layering accelerates and becomes truly unique. Step 3 is the power royalty.
The power royalty.
Remember that behind-the-meter natural gas power plant we discussed?
It's the private grid.
Because that power plant is operating on LandBridge property and the electricity is crossing LandBridge property to get to the data center, LandBridge takes a cut.
Wait, how is that structured? Are they taking a percentage of the overall profits of the power plant?
Usually it's structured as a volumetric royalty. They get paid a fractional amount for every single kilowatt hour of electricity that is generated and consumed on site.
That is incredible. I mean, if we are talking about 2 gigawatts of power running 2,047, 365 days a year to train AI models, a fraction of a cent per kilowatt hour equates to an absolute river of cash.
Exactly.
So if a traditional landlord gets paid for the apartment space, LandBridge is getting paid for the apartment space, and the MBD, they are taking a cut of the electricity the tenant uses while sitting in the apartment.
You've got it. And then comes step 4.
Let me guess. Water?
The water royalty. The data center is running hot, right? So WaterBridge is pumping millions of gallons of cooling water through pipes on the property. LandBridge gets a royalty fee for allowing that supply of water to cross their surface.
Wow.
And then when the heated wastewater comes back out to be disposed of in the deep wells, LandBridge gets another royalty fee on the disposal volume.
So they are taking a cut of every single electron and every single water drop moving through the tenant's operation. They aren't just a landlord. They are like a multi-utility toll collector.
And when you stack all 4 of those layers, the base rent lease, the continuous power royalty, the water supply fee, and the water disposal fee, all on the exact same 3,400 acres of dirt, the financial math goes completely parabolic.
Let's look at the actual SUE numbers to see how parabolic it actually gets.
Yeah, if we look at their historical filings, their surface use economic efficiency was $465 per acre back in 2022.
Okay, 465.
By 2025, just by layering traditional oil and gas infrastructure, pipelines, roads, electric lines for pump jacks, they drove that metric up to $1,159 per acre.
So they more than doubled the yield of the land in 3 years, just from standard oil field activity.
But the data center layering is a completely different magnitude. With the digital pivot, their stated corporate target is to push the average SUE across their entire portfolio to over $3,000 per acre.
Tripling it again.
And it gets even more extreme. Internal Griffonomics reports indicate that for the prime digital plots, the specific acreage where these 2 GW campuses are built, they believe they can hit a SUE of $20,500 per acre.
Generating $20,500 of pure cash flow per acre per year on desert scrubland in West Texas.
It's amazing.
That's the absolute definition of value creation. But listen, this is where I have to step back. Because whenever I hear a financial pitch this perfect, zero capex, 80% free cash flow margins, $20,000 an acre, targets on dirt, captive tenants,
My radar just goes off.
as it should.
It sounds bulletproof. But in the energy sector, there's always a hidden trapdoor. If this is such a perfect ecosystem, what is the fatal flaw?
You are absolutely right to be skeptical, and that's why we have to look very closely at the regulatory environment, the physical reality of the geography, and specifically the Griffonomics short seller analysis that was provided to us.
Okay.
Because there are two massive bear cases hovering over this entire narrative like really dark clouds.
Let's transition to the risks then. Let's start with the geographic and regulatory moat. We touched on how Texas has a pro-infrastructure permitting environment compared to the zoning gridlock in legacy hubs like Northern Virginia.
Right.
And LandBridge offers fee-simple permanent surface ownership, which means the tech companies don't have to worry about local councils revoking their permits or their leases expiring in 20 years. That is the Texas advantage. It's the reason companies flock there. But the geology of the Permian Basin hides a severe risk. This is what the short sellers call the seismicity guillotine.
The seismicity guillotine. That sounds ominous. Break down the mechanics of this for me.
To understand the seismicity risk, we need to talk about the Texas Railroad Commission, or the TRRC.
Which is the state agency that regulates the oil and gas industry in Texas, despite the name.
Right, and we need to look at what is actually happening underneath the ground when WaterBridge injects millions of barrels of wastewater into these disposal wells.
Okay, let's visualize this. When they inject water, where is it actually going?
It's going into pore space. Now, a lot of people imagine an underground cavern or a giant empty lake. That's not what pore space is at all.
Right, it's not a subterranean swimming pool.
Exactly. Pore space refers to the microscopic gaps and fractures between grains of sand and solid rock, deep underground, far below the water table.
Like a hard sponge.
Yes. When WaterBridge disposes of produced water, they are pumping it under high pressure into these microscopic gaps in deep geological formations, like the Ellenberger Formation.
And what happens when you pump millions of barrels of water into rock every single day for years?
You get what geologists call overpressuring. You
Yeah.
are continuously adding liquid volume to a fixed space. It increases the pressure in the rock formation, and if that pressure builds up near a natural geological fault line, the water basically acts as a lubricant. It causes the fault to slip.
Which induces an earthquake.
Yes, induced seismicity. And the Delaware Basin has been experiencing a very significant, undeniable increase in seismic activity, real earthquakes being felt at the surface.
And the regulators can't ignore that.
No, they can't. In response, the TRRC has had to step in aggressively. They have established seismic response areas, they have suspended certain deep well injection permits entirely, and they are aggressively curtailing the volumes of water that operators are legally allowed to dispose of.
Okay, so the state regulator is stepping in and saying, the ground is shaking too much. You have to stop pumping so much water into the earth. How severe are the projections for these curtailments?
The projections in the Griffonomics reports are severe. Operational disposal capacity in the State Line region, which is the heavily drilled border area between Texas and New Mexico, where a lot of this activity occurs, is projected to plunge roughly 51% by 2035 due to regulatory caps and pressure limits.
A 51% drop in disposal capacity. That sounds like a catastrophic bottleneck for the entire region.
It's a huge issue.
But wait, I want to challenge the short seller thesis here for a second. I read the Q1 2026 State Line Infrastructure Report really closely, and it explicitly says that LandBridge currently benefits from owning 2 million barrels per day of permitted low-pressure pore space. They aren't heavily concentrated in the high-pressure, deep earthquake zones. Doesn't that actually make them a premium alternative? I mean, if everyone else's disposal wells get shut down by the state, don't the oil companies have to route their water through LandBridge's low-pressure wells?
That is the exact bull argument management makes, and it is entirely valid in the near term. In the short term, LandBridge's low-pressure pore space is a massive competitive moat. They act as the vital pressure release valve for the entire basin.
Go ahead.
If you are an oil producer and your usual disposal well gets shut down, you gladly pay a premium to pipe your water over to LandBridge.
Right. Their toll booth becomes the only open lane on the highway.
But the short seller thesis looks further out. It asks a darker structural question. What if the TRRC mandates become indiscriminate?
What do you mean indiscriminate?
What if the state of Texas decides the seismic risk to local communities and infrastructure is simply too great across the entire Delaware Basin, and they aggressively shut in disposal volumes across the board, regardless of whether it's high or low pressure?
Oh, if that happens, the music stops entirely.
Exactly. Remember the mechanics of their contracts. LandBridge surface agreements don't typically have massive minimum volume commitments where they get paid a flat fee regardless of what flows.
They get paid per barrel of water disposed.
Right. So if the TRRC regulatory hammer falls and chokes off the total volume throughput across the basin, that revenue dries up immediately.
And let's connect that back to the revenue mix we discussed earlier.
Yeah.
72% of LandBridge's current revenue comes from surface use and produced water handling.
Yes.
If the seismicity guillotine falls on water disposal, the absolute core engine of their current business model takes a devastating overnight hit.
It's an existential regulatory risk. But beyond the geology and the regulators, there is another massive bear argument here, and this one is entirely man-made.
Okay.
There is a severe structural risk embedded in the very ecosystem that makes LandBridge successful. Let's look at market skepticism, bear case part 2, affiliate dependency, and the leverage trap.
This is where we have to stop looking at the shiny 2028 AI data center projections and look at the cold, hard reality of the balance sheet today, right?
Exactly.
Because the current reality is that 100% of LandBridge's needle-moving cash flow today is tethered directly to cyclical oil and gas activity. We just laid it out. 72% surface and water use, 22% resource sales like cullies for drilling pads, 6% O&G royalties.
It's an oil field services balance sheet.
Exactly. The digital revenues, the massive 2-gigawatt base rents, and power royalties, that is years away. And right now, it is entirely based on a $2.6 million option.
And you have to remember the mechanical nature of an option. It has a walkaway mechanism.
Right, they aren't forced to build.
If PowerBridge hits a wall, say the supply chain for gas turbines gets backed up for 5 years, or the hyperscalers decide they prefer a totally different cooling technology, or AI model training becomes drastically more efficient, and they don't actually need 2 gigawatts anymore, PowerBridge can simply let the option expire.
And LandBridge keeps the $2.6 million, but they are left with nothing but their legacy oil field revenues.
Exactly. And that leads into the deeper, more complex issue, the puppet strings, the affiliate dependency risk with 5 Point Energy.
This requires looking very closely at the corporate governance structure. Because 5 Point Energy, the private equity sponsor, owns approximately 63% of LandBridge's voting power.
They effectively control the company.
But it goes further than just majority voting control, doesn't it? If you read the fine print of LandBridge's corporate SEC filings, the structure explicitly waives standard fiduciary duties and independent arm's-length protections.
It does.
Let's translate what that SEC waiver actually means in practice. Because if you own shares of a standard publicly traded company, the board of directors has a strict legal fiduciary duty to maximize the value for all shareholders.
Right.
If the board acts in a way that enriches themselves at the expense of the public shareholders, you can sue them.
Exactly. That is the bedrock of public market investment.
But by waiving that fiduciary duty, reading between the lines here, it effectively means 5 Point legally has the right to pursue actions that benefit 5 Point's overall ecosystem, meaning WaterBridge and PowerBridge, even if it actively harms or dilutes the returns of LandBridge's public minority shareholders.
You've hit the nail on the head. So let me paint the nightmare scenario that the short sellers point to.
Paint it.
Let's say building the 2-gigawatt private power network for the Alpha Digital campus costs PowerBridge $3 billion, and building the new massive water pipeline network costs WaterBridge $2 billion.
Huge numbers.
5 Point Energy is ultimately on the hook for financing all of that massive capex for their private entities.
And 5 Point controls LandBridge, which is currently generating 80% free cash flow margins.
Right. So what stops 5 Point from using LandBridge as a piggy bank? What stops them from forcing LandBridge to accept drastically sub-market lease rates or royalties? 5 Point could sit across the table from themselves and say, hey, LandBridge, we need you to take a massive haircut on your rent and water royalties so that PowerBridge can afford to buy their expensive gas turbines and hit their internal rate of return.
They could legally use the public company, LandBridge, to subsidize the capital expenditures of their private companies.
The SEC filings actually note this risk explicitly. They state that many of LandBridge's surface agreements with their affiliates dictate that payments are subject to annual redetermination by us in our reasonable discretion.
Annual redetermination by us. When us is the exact same group of guys running both sides of the table, the risk of margin compression is incredibly real. They can just change the toll rate whenever it suits the broader ecosystem.
And this affiliate risk leads directly into the leverage trap. Because LandBridge isn't just sitting on a pile of cash waiting for the future, they are carrying a significant debt load.
Let's look at those balance sheet numbers.
LandBridge is currently carrying $545.5 million in debt. Based on their earnings, that gives them a 2.7 times net leverage ratio.
Okay, a 2.7 times net leverage ratio means their total debt is 2.7 times their annualized earnings. How does that compare to their own internal targets?
Management has a stated long-term target of maintaining a leverage ratio of 2.0 times to 2.5 times. So currently, they're actually sitting above their own stated target ceiling.
So the bear case effectively connects all these disparate dots into one cohesive thread. You are a company highly leveraged at 2.7 times.
Right.
You are entirely 100% dependent on cyclical oil and gas drilling activity and produced water volumes to service that $500 million debt today.
Yeah.
And if E&P activity dips because oil prices fall, or if the Texas Railroad Commission drops the seismicity guillotine and caps water disposal, your cash flow shrinks rapidly.
And while your cash flow is shrinking, your corporate parent, Five Point, has the legal right to squeeze your lease rates to benefit their other company.
Exactly. And you are holding this heavy debt load, navigating regulatory risks and corporate puppet strings, all while just waiting for a theoretical 2028 tech payout that PowerBridge might just walk away from if the macro environment shifts.
That is the complete synthesis of the bear argument. They argue that the staggering 88% EBITDA margin isn't a permanent structural floor enabled by brilliant monetization layering.
No.
The bears argue it is a cyclical peak bloated by inherently lumpy upfront damage payments from oil field activity that is fundamentally about to cool off.
Wow, okay. We have thoroughly examined both sides of the coin here. We have the absolute gigascale utility bull case where they hold a monopoly on the dirt, power, and water for the AI revolution.
And we have the structurally fragile, debt-laden, regulatory risk bear case.
It's time for the final verdict, synthesizing everything in these reports. What is this company? Are they a legacy landco or are they a digital utility?
Well, synthesizing the massive amount of data, the financial engineering, and the physical constraints we've covered, the verdict really comes down to how you evaluate the durability of that 88% margin.
Right.
Management has deep conviction that their commercial pipeline visibility proves the model. They look at the upfront option fees, the generation interconnection requests, the equipment orders, and they see tangible proof that these lumpy upfront payments are actively transitioning into long-duration, recurring digital revenues.
They think the pivot is real.
They genuinely believe the capital-light nature of their business completely insulates them from the heavy lifting, allowing them to truly function as a high-margin utility without the crushing CapEx burden.
And ultimately, this analysis changes completely depending on your timeline and your view of the macroeconomic environment.
Totally.
If you believe the AI data center boom is an unstoppable secular force, and that hyperscalers are so utterly desperate for power and water that they will happily fund these multi-billion-dollar behind-the-meter private grids in West Texas,
Yeah.
then LandBridge is a genius play.
They are the ultimate gatekeeper.
They just sit back, provide the dirt, provide the water, and let the 80% free cash flow margins roll in for decades as SUE climbs to $20,000 an acre.
But if you view this transition as a highly fragile waiting game, if you think the 2028 operational timeline is inevitably going to slip to 2030 due to supply chain issues, or that the regulatory hammer is going to fall on water disposal long before the digital revenues can arrive to replace the oil and gas revenues,
then that 2.7 times leverage looks very heavy.
and the affiliate dependency looks very dangerous.
It is a massive high-wire act over the Permian Basin. And frankly, looking at this convergence of digital infrastructure and energy leaves me with one final, broader macroeconomic question.
What's that?
It isn't fully answered in any of these transcripts, but it is the logical conclusion of everything we've discussed today.
I think I know where you're going with this.
If hyperscalers like PowerBridge and the major tech giants are successfully building these massive private natural gas grids, these behind-the-meter setups to completely bypass public utilities in places like Texas, What does that actually mean for the future of the traditional U.S. utility grid?
That is an incredibly important question that goes far beyond LandBridge. It impacts the entire country.
Right. Think about the economics of public infrastructure.
Yeah.
If the biggest, most lucrative, most power-hungry corporate customers in the world completely secede from the public power infrastructure and just build their own private, perfect energy islands.
Who is left paying for the grid?
Exactly.
Huh.
Who is left paying for the maintenance, the upgrades, and the green energy transition to the public grid? Does the multi-billion-dollar cost burden shift entirely to residential consumers and small businesses who just don't have the capital to build their own power plants?
It suggests as a fundamental, potentially highly unequal restructuring of how power is generated, distributed, and monetized in America over the next 20 years. And LandBridge is sitting right at ground zero of that grand experiment.
It is the ultimate test of the digital energy convergence. We will be watching those 2027 and 2028 milestones very closely to see if the vision becomes reality. Risk defined, portfolio protected.